This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today on the show, I have Tim Pickering. Tim is up in Canada. He's going to tell us a little bit more about where he's exactly located. But I do know there's quite a bit of oil fund taking place in his location. But Tim runs a fund. He is the lead portfolio manager of Auspice Capital. And we're going to get into all the details of what that means and all the behind the scenes. But Tim, welcome.
Thank you very much, Michael.
So, I don't know if you heard me do this recently, but I like to get people to, and it's hard for folks in your position because you guys are swinging it up there. You're making things happen. But I want to know what Tim was doing back in the day, because everyone wants to imagine being a fund manager and managing many, many millions of dollars for clients. And this is the dream that people want to have. You're living the dream. So what were you doing when you were like 13, 16, teenager? What were you thinking about? What was going on in your life at that point in time?
I'll give a bit of background to myself. I'm a farm kid, come from a farming background in our middle Canada, the prairies of Canada, grain farming operation. And I still remember, and I must have been 7 or 8 years old, going down to a futures broker in Saskatoon, Saskatchewan, Richardson Green Shields. It's a part of the Richardson family dynasty. And my dad, watching the ticker on rapeseed contracts, what is now canola. And something got planted in my head at that point regarding trading and hedging, I guess. And it stuck there somewhere in the back of me for quite some time. And I don't know what it was, but the concept about trading just stuck with me into high school. And when I left high school, I knew exactly what I wanted to do for a living, and that was to be a trader. I didn't yet know what that meant, but that was what was in my head. The question was, how do I accomplish that? So I went to...
were you trading in high school at all?
Yeah, I did. I traded, penny stocks. And in Calgary here, we had a small regional stock exchange called the Alberta Stock Exchange. It was enveloped under the Toronto Stock Exchange brand years later. But it had some history too, because essentially any junior oil company got its start on this Alberta Stock Exchange and then made the jump to the big board in similar concept to the U.S. And it also had a fair bit of notoriety in that Bre-X, and I don't know if you remember the Bre-X story, it was a fraud around gold mining. That was based on that exchange, so it received some notoriety. And that was one of the first ones of that variety, much to the chagrin of many Canadians. But that was in my head, and it was really just how do I get to where I want to go to?
But at that time, let's say your teen years,
yep.
Before the age of 18, you say how to get to where you want to go to. Did you really know exactly where you wanted to go at that moment in time?
No, because I didn't really know what trading was, or I didn't know the scope of trading. I mean, here I'd seen these futures contracts traded regarding ags, but really, as far as I could tell, it was all about stock trading. And really, that was the scope of my experience. It was, very simple. There weren't many resources. There wasn't the good fortune of picking up a book like Trend Following that kids will do now to get sort of a scope of what kind of traders there are, or other work where that's been featured, like by Jack Schwager, for example, that has featured many types of traders. There was nothing like that available at the time, or at least pre-internet, it just was a lot harder, as you know. So, it was just trying to figure out, how am I going to go about this in what way? And it really was surrounding stocks, because that was in my backyard, and the oil stocks got talked about a lot. And so that was kind of the quest. And actually, needless to say, as I went to and did my undergrad at the University of Calgary in finance, one of my last summer job in my last year of university was indeed at the Alberta Stock Exchange as what's called a board marker. The traders threw tickets at my head, and I had to catch them and put them through the system and mark them up on the board.
Was that your first kind of professional indoctrination to the markets?
Yeah, I mean, that was, still in university summer job, but that was the profession. Yeah, that was the indoctrination into this wild floor world. Yet it was still stocks, but it was a pretty wild environment because it was a junior exchange, and there was lots of resource-related plays which have various bits of excitement associated with them. And so that was the first love, and then at school at University of Calgary, I pursued that concept, or started to research that concept in stock trading, and I was clearly not destined to be an investment banker. The University of Calgary was heavily recruited by a couple paths, one being management consulting, the McKinseys of the world, and the other being by investment banking firms from Toronto and New York, heavily recruited out of the University of Calgary. Salomon Brothers did a very big push out of my university. And so if you were anything, you hopefully had a good relationship with a prof, and he maybe made a recommendation. So you got an interview with Salomon Brothers or with McKinsey. Of course, those things did not appeal to me one iota.
But hold on. Were you not chosen, or you just had no interest?
Zero interest whatsoever. And I'll tell you a quick story. I mean, I remember being in the finance class, and it's quite a small class, and the prof started to ask people, what do you want to do with this finance career? What's your path? Everybody puts up their hands, and most of the people were, really answering that way. I want to be an investment banker. I want to be in management consulting, or that sort of thing. He said, Pickering, what do you want to do? I said, I want to be a trader. And he basically just went off. He said, being a trader is akin to being a taxi driver. It's just no future whatsoever. And that'll stick with me for the rest of my life, him saying that. And so it really became about, how do I learn more about this, and how do I get down this path? And so a next very important story in my career happened in my fourth year of university of my undergrad, so my last year of my undergrad. They did a career night at the University of Calgary. And they brought in past grads who had gone on to great success in some capacity. So they brought in your typical accounting guy, and they brought in the management consultant, and they brought in a very successful investment banker, and they brought in a very successful institutional equity salesperson who's actually gone on to great success here in the Canadian marketplace. Somebody who's very admired, George Gosby, who ran TriStone, now runs Alticorp. And then the last person who I owe an immense gratitude to was a person that worked at Toronto Dominion Bank on their trading floor. They had a small trading floor in Calgary as a sub of the Toronto trading business, which is hundreds and hundreds of traders. And of course, after everybody got up and talked, you get a chance to go talk to these people. And of course, everybody just pounced. All these fourth-year students just pounce on these people. Go shake the hand of the investment banker and ask them questions. And here's this guy off in the corner, this FX trader from TD Bank. And of course, I didn't even really know what FX was. I've heard about it and listened and kind of got the currency concept. That didn't really mean anything to me. So I went over and talked to him. And his name's Nimish Patel. And I introduced myself, and I said, I'm very, very interested in the trading area. And he said, I think he was quite happy that somebody came over and talked to him. And he said, that's great. Maybe you'd like to come by the trading floor sometime. It was another pivotal point in my career. And I said, absolutely. And a few days later, he actually called. And I remember rushing home from school to put on my suit, terrible suit, to rush down to downtown Calgary so I could go sit with him for the afternoon on this trading floor. And the latter part of the story is TD Bank came and recruited from the university later that semester for what they called their trading development program. And the trading development program was to put you through a rigorous risk management philosophy and give you exposure to currency trading, fixed income trading, money market trading, capital market derivatives trading, and commodities wasn't even mentioned. Okay, but I thought, that's for me. I don't have the marks, but that's what I want to do.
Well, let me stop you at that point. So I know this is essentially the beginning of your career, getting into this trader development program.
Yeah.
That's the beginning. So here's what I want people to understand. You are currently today with Auspice Capital. You're running a trend following firm, and we're going to get into some of the details. However, what I would be useful for, I think, the audience is for them to understand, okay, here you are starting with TD in this trader development program.
Yep.
What age are you specifically?
I'm a fourth year undergrad, so I am. I graduated from university in 1995, so I was 23 years old.
Okay, you're 23. At what age? Since now you are this very successful trend following fund manager, at what age did the full concept of trend following hit you? So we got a beginning at 23. At what age was the full concept of trend following hitting you? And then we're going to fill in the blanks as to some of that process, but I'm curious if I just know that from the beginning.
I think it took a while. I went through the trading development program, and so latter part of my being 23 there. And it still didn't totally dawn on me. It was the next year in 1996 as I came out of that program, and I was offered the opportunity to trade energy and commodities for TD Bank, and sitting down with some of the principals at TD Bank, and when they asked how I was going to go about things or what I was interested in, it was really a risk management based philosophy. I said, my overall philosophy is. They literally asked, how are you going to go about trading energy? And this is why my path is different. I was offered the energy desk. How are you going to go about trading energy? And, I'm not going to BS anybody and say I knew the fundamentals of oil and gas left, right, and center, because that's kind of what they were asking. I said, look, my overall philosophy is quantitative. It's trend following in nature. I believe in risking one to make three and being very disciplined about that, going about the markets in a very agnostic fashion.
Okay, but let me stop you for a second. So that was within 1 year? So you start...
That was within 1 year. So you go through the program, and the idea of coming out of the program is hopefully if you've showed an aptitude towards risk management and got some exposure to one of those desks, that you get the opportunity to be a junior trader on one of those desks.
Well, let me drive in here though, because I'm really curious. So,
sure.
So you're 23. You start this program. Most of these, even if whether it's back in the day, Salomon Brothers, they were not indoctrinating traders into trend following trading. So what took place in that 1 year time frame that really got you to be using the phrase trend following? Because it wasn't in the program, correct?
Well, and it wasn't even in that vernacular. That concept wasn't overtly. What I was thinking about. It was, I got the trend following concept, but here was the pivotal point, was here I was being offered the energy desk at TD. I mean, I literally was at 23, at 1996, was being offered the opportunity to trade energy for this conservative Canadian bank. Now, if you're a conservative Canadian bank, they get the concept of non-correlation within. That's what the trading business is for within the banking system. Now, within the trading business, commodities and energies are going to be, if done properly, non-correlation within the trading business. So they got that concept. I got that concept. But here's the reality, is that bank believes in very stringent risk management. So this is the pivotal point, and this is where this all comes to a head, and my path is unique, is when I started to explore trend following concepts and some of the other proprietary traders started to trade in energy. And what we witnessed is it didn't work very well. The traditional ways that they were approaching trend following within the financial market, so I mean currencies, interest rates, and maybe some equity indices, was not working very well. The way they had done it in those markets didn't work very well, Michael. So I got this front row seat as I was coming out of the program and taking on this role to see this somewhat failing. And the question became, well, why wasn't this method of trend following in these low vol financial markets working in, say, energies? And so we got to dissect that. And the immediate response is the very obvious thing of being a CTA, and that is, well, if you're trading a higher vol commodity, you need to normalize your risk, you adjust your position size. There's kind of the basic, obvious answer, right? Well, you need to re-optimize that strategy for a higher vol commodity. Well, that's just re-optimization. But here was the key thing for me. When I did that research on the way they were going about trend following, building these strategies specifically for these low vol commodities, I realized this was the challenge in energy. Energy markets go through these paradigm shifts in volatility. Natural gas will be at 30 vol, and then it'll go to 130 vol. And the way not only the capital allocation and risk management aspect, Michael, needs to adjust. That's the obvious. But what else needs to adjust is the actual strategy needs to adapt to that different market dynamic. Okay, and this is really the critical step in how I go about and think about trend following. So when I sit back and say, well, what works? What kind of a trading methodology works in a market as heretic as natural gas that'll go from 30 vol to 100 vol back to 70 vol? Well, if you think about it, what works is discretionary concepts where you can make the adjustment to the different market paradigm or market condition. But I was already indoctrinated and believed in systematic process. So the question became, how can I marry those concepts? So the idea was to create adaptive approaches within a systematic process. So take the discretionary experience and that philosophy, but when you apply that discretion, you're doing it in a systematic way. So what I mean by that is you're coming up with a process to apply a methodology, but you're applying it in a systematic way. So it's really a systematic I'm doing a poor job of explaining this. It's a systematic application or systematic execution of a discretionary philosophy. The systematic process is allowed to adapt through market change, right? So as an example, not only does your capital allocation and risk management change with volatility, that's very basic, but your definition of trend. If you've gone through a process and figured out what the most robust breakout is across a very wide, disparate set of asset classes ranging from cotton to currency to crude, and you say, well, the best breakout in history, the most robust breakout in history is some number, and you've come up with a robust methodology to determine that. Well, how about have that breakout adjust based on volatility or some measure of risk, because a 2-day breakout isn't going to do you any good in natural gas, and maybe not even a 2-week. In a high vol environment, maybe you need to look back 2 years. And so it's coming up with that concept where you're applying this systematic process-oriented concept to a discretionary adaptation, right? That's basically the vein of my work.
Let me slow you down for once. I have to take you back, okay?
Okay.
Because I think you've just brought us up to current day Auspice Capital, okay? So we're jumping ahead. I'm still at a point and I'm sure there's people out there that are saying, okay, I want to bring everything up to the front where we're at right now. But I think the audience is really curious because when you say you're a 23-year-old guy and you're entering a trading program, and then you say that, okay, there was a shift to a classical trend following understanding within 1 year's time frame. Generally, most of these programs in the large banks aren't teaching trend following. So what I want to know is specifically, what was influencing you? Was there any outside reading? Was it outside traders?
There was both.
Okay,
there was inside traders.
What was driving you to understand this concept of trend following within 1 year? That's who.
Like when I say within 1 year, I was getting a loose understanding of it. Where it was at 23 years old and where it is here. Many years later.
Okay, well let me phrase it to you this way. So at 23. How many years went by before you understood trend following in, like, for example, the classical sense of some of the famed U.S. CTAs, the Duns of the world?
Listen, I didn't. This is not a word of a lie. I didn't get into researching who those CTAs were, Michael, until much later in my career. Actually, post TD Bank, once I went to Shell 5 years later. So I had done research. I started reading magazine articles in technical analysis and of the Task Magazine trend following concepts that would be in those articles. I started reading just bits I could find out there, stuff that was at TD Bank. They had various bits of literature. The basic concept was there, plus the prop trading group that I was a part of applied some of these concepts. But again, it was just, it was very basic, and it was their way of going about it. When this developed, Michael, you have to understand, I didn't know what a CTA was until I was on to Shell 6 years later.
Okay, this is what I'm trying to. Maybe I'm not clarifying myself. What I'm trying to gauge is from the time you entered the industry to the time you had a full understanding of what trend following is, how many years elapsed? That's the kind of curiosity I
probably 7 years.
Okay, because I think that helps people to relate to the idea that sometimes this subject, you can be off in the wilderness and you don't necessarily get there in a straight line. For example, there's some traders that you and I both know out there that were lucky enough at a very young age to be told, oh, here's trend following. And they knew it like 22 or 21 or 18. And what you're painting, and what I've seen many great traders have this experience, is they don't necessarily get there in a straight line. And that's what I'm trying to get you to kind of let the audience see.
It was definitely not a straight line, because I knew the concept of trend following and systematic trading. I didn't know what a CTA was. I didn't know we called this group trend followers. To me, it was just quantitative trend following. It was just part of the quant group prop trading methodology that was used at the bank that I was given the opportunity to be trained by. I didn't have a label on it. I didn't know what a CTA was. I surely didn't know what managed futures was. It was simply quantitative trend following within the bank.
Gotcha.
And so it started at TD with that path. But if you think about where I started focusing trend following on a very tricky thing to trend follow, and that's natural gas and really the energy space. But at that time in 96, 97, natural gas and crude oil, especially natural gas, was really becoming the rage. I mean, it was a very volatile commodity. It was a very exciting commodity. And here was some of the epiphany points for me was, if I'm going to trend follow natural gas, it's easy to find trends in natural gas. It's pretty hard to capture those trends if I'm, just using some simple, robust, long-term trend following methodology. Whatever one you want to pick, a moving average, a channel breakout, like whatever the thing is. But it's very hard to capture that trend in a market as crazy as natural gas, because when it turns around and goes back the other way, it's trading 100 vol. And still at TD, what I developed in my mind was, look, trend following is an easy concept. Trend capturing is a little trickier. And so how do I go about that? And that was the start of my work at TD, and it just started developing from there.
Okay, let me jump into some broad subject areas, because I think you've got some interesting stories that will help people to kind of see some of your perspective. So one of the favorite criticisms of folks, my industry, your industry, is people like to just say, they throw this word out there. They throw black box. And it's like apparently it's kind of like a scarlet letter type thing, that if the supposed learned person over here who has all of the supposed fundamental expertise, if they simply open their mouth and say black box, apparently to the uninitiated, to those not informed, that alone will basically just say, don't listen to this guy Tim, this guy Mike, don't listen. So talk to me about your dealings with this phrase black box, and I think you have a little story about it.
I do, and I mean, listen, this is so much a part of what you are as a CTA. This issue coming up. The way I like to describe it, and then I'll get into the story, but the way I like to describe it is, look, there's nothing black about this box. It couldn't be more transparent. Either for good or for bad, CTAs are very open and overtly talk about the way their strategy works in general, and the philosophy. Of course, because we as CTAs have embraced technology and created this repeatable process, it's getting shoved in this black boxes. And I think if you go back in time, way back, original trend following, probably people coveted that that strategy very closely, and I covet mine too to some degree. I'm pretty open about positions, but what the strategy is, I think it was probably protected. Maybe there's some misnomer because of that in history. Regardless, here's what I've discovered, and then I'll get into the story. It doesn't matter if you trade systematically like we do. We're completely systematic, non-discretionary, or you trade fundamental discretionary. If you look at the very good traders in history, and the ones I've experienced in my careers at a great bank and a big trading organization like Shell, the really good traders, even if they were fundamental discretionary, applied their strategy in a very process-oriented way so that it was repeatable. Even if it was up in their head, that's what they did. And specifically, and this is very important, and it's the front end of any CTA, they applied the risk management and capital allocation aspect in a very systematic way, even if it was up in their head. Those successful traders do that in some capacity. In CTA, we're just very open about it, that we've embraced technology so that we don't mess it up. And really, for me, it was that simple. How can I trade different markets, and markets as crazy as natural gas, and apply that in a systematic way? That became through this concept of people akin to black box. And we're very transparent as CTAs about it. Here's the analogy. I got asked this question. I was asked this question a couple of years ago, and it caught me off guard. And the only thing I could think of at the moment was this. I flew here to Chicago today, and this was at that moment, on a plane from Calgary. And if I got on that plane this morning and the pilots came on the intercom and said, well, we got good news and we got bad news. The good news is we're still going to Chicago today. The bad news is all the computer systems on the 747 are down. But no worry, we have a lot of experience, and we're going to fly this plane on manual to Chicago. We've got a lot of discretionary experience. We've seen a lot of stuff happen. No worries, we don't need the computers. Are you staying on that plane? I know I'm getting the hell off that plane. And it's the same philosophy. Why not embrace technology? We do it in so many aspects of our life. Medical, transportation, logistics, you name it. Airplane concept is just one. But the reality is, why would anybody not embrace technology to make their strategy more consistent? If you're more consistent, then you reduce the volatility of returns. And if you reduce the volatility of returns, you produce a better risk-adjusted result. And ultimately, your investors, whoever they may be, are happier. That's it.
Well, listen, it's not that they're not embracing it. It's the folks that are your competitors, who are the fundamental competitors, need to say something nasty about what you're doing because they either can't do it, they're jealous of it, or they start to realize that the hocus pocus guy behind the curtain routine that is par for the course on so many of the financial talk shows, that systematic trend following type managers start to raise questions about the hocus pocus. And so I think what we see some of, the hocus pocus guys, they got to figure out something to say negative. And you might not be able to say that, but I can.
No, listen, I feel the same way, and I can say it. I mean, I am extremely passionate about the CTA space now that I know what I am, and we're very open about it. We're very transparent about what we do. Our business model is a bit different here, and we'll probably get into that. But we're very transparent about our positions and how we go about approaching the markets, and we're doing everything we can to get away from that black box concept.
Let me clarify something too, because I know folks that listen to my stuff will know where I come from this, and I know in your position running a fund, there are certain phrases that have to be used, and the space where most trend following managers have come to operate has been called managed futures. And the formal government regulation is to be called a CTA or a commodity trading advisor. Right. And I want people to understand that fund managers have to use these terms often because of that's what larger investors understand. That's how the government regulates. But
you need to fit into a box.
Right, you need to fit into a box. But at the end of the day, those don't describe necessarily what the manager does. And I think those can be misnomers where your strategies are going to be these in your case, trend following strategies, many multi types of trend following strategies together. But the phrases, when you say you're a CTA, I think I want people to understand that that's not necessarily the best description, but it's the description in our world that we have to use. And
it is. And I mean, I listen, I was on the road yesterday with a team in Toronto and talking about what we do. And I kept saying CTA, and I pretty much use it interchangeably between managed futures. And I mean, a lot of people in Canada don't even know what a CTA is, because that's not a designation by our regulator. That's obviously a CFTC-inspired thing at the institutional level, or driven by the U.S. regulator. So that's an unknown here. And I think it's CTA. Of course, as soon as well, what's a CTA? Commodity trading. Like, so you just trade commodities? Well, no. Exactly. And of course, it immediately confuses everybody. Right. Listen, here's one of the things that I took away when I started trading at TD and was told by a guy I had a lot of admiration for. He basically said, look, if you apply your strategy in a risk management oriented way, like you say, risk 1 to make 3, it doesn't matter if you're trading orange juice or cotton or coffee. It's really just applying that strategy to that marketplace, and that's the opportunity. Just do that. Don't worry about the fundamentals, and don't worry about all these other things. Just worry about applying that craft, that technique to any market that makes sense for that craft.
Tim, what's the source of your profits?
The source of my profits. The source of my profits, and the bulk of what I believe alpha is in this space, is risk management and capital allocation. Trend following and the first step in our process, saying, is a market going up, is a market going down, is a pretty basic thing to do. I think kids can read books. Young 23-year-old people on a bank trading program can figure out what a trend is. The question is, can you capture that trend? That's the hard part. This also leads to a big debate between original legacy, what I'll call legacy or first generation trend following, and next generation trend following, where we focus more on capturing open equity or mark-to-market gains versus closed equity, and experience a lot more volatility in that original concept of trend following. So that's a whole debate. But the source of our profits is capturing that trend and getting involved in that trend and capturing that trend before it reverses and going the other way.
Okay, I'm going to let you dig into that even more, because I'm just going to pretend I'm the wealthy attorney, doctor. Maybe I'm not even wealthy. Whatever. I'm just somebody that wants to make an investment in you, and I'm making comparisons. And on the TV, there's a nice looking older guy from Omaha that eats a lot of ice cream, and he says that if I just go along with him and I buy Coca-Cola and I shave a lot, I'm going to be really wealthy in the long run. So you kind of know, well, okay, everybody has to shave and everyone has to drink Coke, and so I can see how I'm going to make money with that. How am I going to make money with you? I want to understand where's the money coming from, because I'm not shaving, or I'm not drinking lots of Cokes.
Well, listen, the guy from Omaha is very good at what he does, obviously, but we're approaching the markets by saying, listen, we don't know which way the markets are going to go, and what the guy from Omaha has the benefit of is he can handle large swings in his risk. And that wasn't a reality for me developing as a trend follower at a conservative bank. You needed to mitigate your risk, so your volatility, you need to mitigate your drawdown. So if I went and did a bunch of fundamental analysis and said, this is the way I should do things because I like ice cream, or have some fundamental view on a commodity even, I have to endure that market going against me, maybe for a long period of time. The reality is, I'm sure that'll occur sometime, but I don't have the opportunity, I don't have the luxury of waiting for it. In the meantime, what do I know? I know the market's going up, I know the market's going down, and I'm going to simply participate in the market and accept what the market's willing to give me. I'm not trying to predict where it's going, I'm simply trying to participate in it. I'm divorcing myself from that concept. The guy from Omaha may be right, but for every trader that's right and waiting to be right, there's a lot that go bankrupt trying to do it. And
so
it's
you're
really just
you're agnostic to the
completely
market, but you're agnostic to the market itself. You don't
everything.
You're right. You don't care that if let's say, for example, I know some fundamental traders they want to. It seems to be an emotional attachment to how they make the money and the market they make the money in because they got to tell the story. You're not saying that at all in your trading, are you?
No, listen, I don't trade for excitement, and I know that's kind of cliche by this point, but listen, trading is actually kind of a boring process as far as I'm concerned. Again, because we're very disciplined about it and apply it across many markets, many strategies. It's a process at this point, and process can be pretty boring. But what's exciting to me? Well, I'm building a business in being a CTA, and I'm building a business around some next generation CTA concepts and going about it in different ways, different vehicles. Those are exciting things. Building your business is exciting. Meeting interesting people within the trading business is very exciting. I've had the great fortune to meet some of the original turtles, and some of them have become great friends, and that's exciting. That's what gets you up in the morning is meeting interesting people. But trading in itself is not something I look to for excitement. It's simply my craft. It's my trade, if you will, what I do. And I don't look to it for excitement. It feels good when we do well and we risk 1 unit of capital and we get back 10. That feels pretty good. But, in the end, I'm very realistic that most of the time I'm wrong. It's just my winners pay more than my losers. So you have to be very humble to be a trend follower.
I know you are referring to yourself as next generation.
Right.
So walk me down the path. I don't think it's necessarily a criticism of prior generations. You're just you're looking at trend following. You're saying, how can I approach it differently, or that's where you found yourself? Maybe walk me through that process of next generation.
Right. So, there's a couple things. One, I believe the concept of trying to capture open equity versus closed equity is kind of pivotal to this discussion. And so, for example, what I'm saying about my trend following is I'm looking to participate in a trend, and as the volatility or the risk reward, by some definition, I'm not going to get exactly into our definition, but it's more than volatility, changes, I may adjust my position size because I want to take my money off the table or capture some of that trend when I deem the probability of maintaining those mark-to-market gains is diminishing. And that's kind of the first step towards next generation trend following. It's doing something to adjust to capture open market equity. Now, by doing so, and first this was a necessity because I couldn't handle big drawdowns and big volatility where I started trading. I believe that a couple things. One being that it's been challenged that maybe that way of going about it is less robust than saying, look, we don't adjust our position side, we ride it, we're going to have bigger drawdowns, we're going to have bigger volatility, but it's a more robust strategy. And listen, there may be an element of truth to that. I don't know if I could quantify how much more, but here's what I've heard the market say to me, and it started with that conservative bank, and it's with investors now. They're telling me, listen, it's not enough that you're non-correlated to the rest of the asset classes out there, because that's a key, obvious hallmark for CTA. That's one of the key reasons people allocate money to us. That's not enough. You need, at that management level of you being a CTA, to mitigate your risk, to mitigate your drawdowns. And I think where this started 25 years ago or 30 years ago was that wasn't the key driver. The key driver was to get involved in these trends. You're still going to have volatility, just that classic trend following. I'm not saying that's bad. I'm saying what the market demands out of managers has evolved from that point. And people can say, well, how do you prove that? I can prove that very easily, because the bulk of the assets that have come into trend following in the last decade have gone to a handful of managers that embrace that philosophy. If you look at where the bulk of CTA assets are, and easy to point out, it's with Winton. And it's because they've embraced that concept.
They've got it a little bit bigger, haven't they?
Yeah, a little bit bigger. And so I think that that's what I'm saying, is that it's taking that trend following concept and going about it a little bit different. Now, we're just at the tipping point of this because I think it's so much more, and I'm happy to get into that because it's more than just what I described. It's taking the CTA philosophy. This is my view. Being a next generation CTA is taking the CTA discipline, all those good things that being a CTA is, the non-correlation, all those added benefits to a portfolio, and then taking that discipline and applying it to different types of products, different type of vehicles. Wrapped CTA philosophy of trend following risk management and cash efficiency being one of them. Take that and apply it to an ETF or a mutual fund or a different type of structure, a vehicle, or take that concept and maybe change it a little bit to meet an investor need. I'll give you an example. We created an index called the Auspice Broad Commodity Index. It's simply a CTA strategy that's published. And it goes longer. It's either long trending markets going up, and it goes to cash if they're trending down. Well, why would we do that? We know going short, makes sense, right? If it's going down, I'm going to go short. But some investors don't want that. It could be the needs of their investment counsel at an institutional that doesn't allow them to go short commodities or futures in general. It may mean that the reason I'm creating an index is they need an index benchmark to make sure I'm following some sort of third-party generated benchmark tool or an index. So it's taking the CTA philosophy and bringing it out or applying it in different ways. And this is what I believe is the next generation of CTA. And this is the entire vein of my work and the focus of my firm.
Tim, let me ask you a question about that. So one of the classic ways that I learned was looking at disclosure documents of CTAs back in the past. And so you could take 20 or 30 trend following disclosure documents back when you and I were just babes in the woods, and you could start to look at the months and you could say, well, gosh, everybody had a really big winning month in August of 98. And, you could start to make these kinds of judgments and see what's going on. And you start to realize that the classic trend following strategy is great for those unexpected surprises. You find trend following ending up on the side of surprises. And there's been a huge amount of alpha generated from that result of trend following over the decades. Right. Do you think that some of the clients that come to you, because I know you're always going to have a certain component of your business that's going to be trend following. Do you think some of the clients that come to you with the desires and these hopes of having maybe different products cater to what they want, do you think they run the risk of turning what the classic strategy was beneficial for into something else?
Well, it's a complex question. Here's what I believe. If we looked at the classic trend following strategy and then we looked at what I'm describing, and what I'm describing wasn't able to capture the opportunity or the situation you're describing, like that let's call it crisis alpha or something. If I couldn't capture that doing what I'm doing versus that classic trend following, then I would agree with you that is a issue. So the things
the augmentations that you're making are still capturing the classic.
Exactly, okay. Precisely. Okay. You're very good at boiling it down to one point. And if you look at, and I've had this debate, it's like, okay, well, if I'm doing something that is not as robust, and by capturing those trends and cutting my position size or whatever the way I'm going about that is to capture the trends versus just follow them, if that was less robust, tell me this. In 2008, we were up 44%, running a margin to equity average of 7.1%. That's good territory. Yeah. So if I wasn't doing that, if my methodology didn't work in that situation, I would have ran a subpar return versus that legacy trend following approach, and that's just not the case. When we see those situations, we appear to be doing just as well or even better. Now, I will point out one environment where maybe it is a bit more of a challenge, and here's the trade-off. in periods like 2011 or 2009, very similar in that you had a lot of government intervention, you had those extraneous forces on trends that destroyed trends and made it very choppy. Those are the challenging times for CTAs. It appears that a strategy like this gets chopped a little bit more than that longer term, more legacy type concept. Okay, that appears to be the case. But we're talking gradations here. The question is how much? Well, it wasn't so bad last year. I mean, we were down very small last year. We didn't drop 20% in that inopportune period. So I think we can refute most of those concerns. And I think that the assets going to these next generation CTAs like a Winton, and I don't mean to put them on a pedestal, but they're obviously doing something right.
Yeah, they've the price starts at the top. They got a good guy at the top.
Listen, I'll say this about Winton, and I don't know David Harding personally. I will say this. If I've learned anything in building this business at Auspice, is it's not enough to have good returns. It's not enough to have a fund that has done a year like 2008 as we did. It's more than that, because your business has to survive. It has to persevere. And it's one thing that I believe is very, very missed by people starting their CTA. This is running a business. And I think it's very obvious that David Harding is a good business person.
Yeah.